Yeah, I'm losing my edge.
Defending against election volatility, Michael, that's the topic for today. Election is upon us. I mean, it's Tuesday night of next week, so we got a couple of trading days before, but the election volatility has already come. So we might as well start talking about it here on Halloween Eve. And a big part of it is the opportunity. A lot of people, short-term traders love to come to small exchange products, these futures that give you efficiency, and they're small size for speculating and just the increased opportunity that comes with volatility. But a big part of it is also, I have this long stock portfolio, or I am short equities, and it's a long-term trade that I've had on since, April, March, or, 2019, 2018, whatever it is. And now, because of this election, this thing that happens every 4 years in the US, now my position, in my opinion, is all of a sudden vulnerable. And it's something that when I put the position on in 2019, or I put it on 3 months ago, I wasn't really taking into account that the election was coming. So now what I can do is I can put forth some efforts here of varying degree that we'll get to in a second to defend against this election volatility.
Mm-hmm. Yeah, I think this is an important question to address. We saw the last presidential elections volatility. I can remember watching the futures that night, and it was pretty severe. There was a really strong whipsaw, and if you were a long stockholder and you were watching the futures that night, you may have thrown up a little bit. It was pretty severe, and then you kind of benefited from the 4-year Trump rally. But it's an important question to raise, because almost every sector, I would say, is going to be affected by the outcome of a presidential election.
Sure.
And say up or down. But, some people will invest in index funds to avoid earnings volatility. I don't think an index per se is insulated from the outcome of an election.
Great point.
Things
and I'm glad that you brought up 2016 here, because let's focus on that for a second before we get into some of these defensive strategies, Michael. You had on that election night a over 100 point sell-off in S&Ps that night. And guess what? By Wednesday afternoon, the market was unchanged. And that's the type of move that if you didn't have a defensive strategy working for you, that you might have freaked out and said, you know what, I'm ditching some or all of my long positions here because this is not looking good. If Trump does, if the trend continues and Trump is elected and this stock market sinks, then all of my opinions from 2014, 2015, 2016, the early part of it, that have been working for me here from the long side are now being washed away because of this election. And then if you weren't defensive there beforehand and you did freak out, you missed this huge bull market afterwards. So it's this simple thing where it's like, it's like going to the dentist, it's like you don't want to do it, but if you do it, then you don't have to worry about this for like the next couple of months. Like it's tedious. No one wants to say, okay, I'm long, $100 or $1,000 or $10,000 worth of stocks, and now I have to go defend against it. No, I'll just let it ride. But if you just take, this 5-10 minute segment here, and then a couple more minutes in your platform to commit some of these defensive strategies, you get away from all of that fear, all of that stuff that might make you freak out. Because on average, Michael, election week is a full percentage point more volatile than every normal week for the last 4 elections here that we're looking at this data. And this is a big number, right?
Yeah, that's a huge number. I would say, 100 basis points, we look at that as a massive opportunity, but the beauty is you can help soften some of this by just being proactive as opposed to reactive. It's so hard. I mean, I say this and I try to apply it as best I can when I'm trading, but if you're going to stomach a 100 point slide in the S&Ps, you're pretty tough. So I think it's better to maybe pull off some of those basis points here by being proactive.
And we've already seen some of these huge slides. Like we're expecting right now in the stock market a little over 5% in the next week, give or take. And we see today a 2% lower move. We saw an over 1% bounce earlier this week, and we saw to start the week a 2% lower move. So we're already seeing it. And like you said, if you can stomach that and you want to just ride out your long or short positions, go for it. But if you do just a couple of these, you just floss your teeth every once in a while, you're not going to need to go get tooth surgery here. Just go to the dentist for a couple of these different strategies that, I was looking at this earlier, Michael, when I was putting the segment together, and I was going to put, some specific examples with strikes and deltas and all this stuff. And I threw all of that stuff out because I just want to get people on board with what these three options are here, with the intensity of mild, medium, and hot salsas for your defensive strategies. Defending a long position, the least you can do is say, okay, let's stick in the world of Apple. We've got the small stock 75 here, and we've got great futures markets here at the small exchange. But everybody knows Apple stock. It's existed for decades, and a lot of people have. If you've traded anything, you've probably either looked at it or traded it. So you're long 100 shares of Apple, Michael, and you're worried about this election. If Biden is elected, it's going to mean X, Y, and Z for tech stocks, and Apple is going to move down or whatever. You're worried about that, or from the Trump side, it's going to mean whatever it is. A short call is just going to that Apple market, selling what is called a call option against it, which is going to do two things. It's going to define your upside. So if Apple, for some reason, blasts off in the next couple of weeks, you can only make the difference between where the stock is and where that short call strike is. But what it will do that's in your favor, you might be saying to yourself, well, why would I want to tie off the upside? What it'll do is you're selling a call against your stock. So you're taking in money, which will help you if Apple moves lower. Say you sold a call on your Apple shares for $5. If Apple moves lower by $3, you actually covered that $3 in loss and made money on the trade. So that's the mild intensity. Medium intensity is a 50% hedge, which would in essence be, I have 100 shares of Apple. I am going to, for this election, take off 50 of those shares. Okay. And that's pretty simple, but it is a medium. Like, the problem with the short call is if you sell a call for $5, the stock sinks $10 or even more, you only still have that $5. So you still have a bunch of risk. With the 50% hedge, you're always hedged at 50%. Now there's the collar, Michael. That's the hot intensity defensive strategy there. And what that is going to mean is you're going to sell a call and you're going to buy a put. Now that long put option is going to stop all of the bleeding at a certain point. If Apple in this scenario is trading at $100, you sell the 105 call and you get a couple of bucks, and then you buy the 95 put. That 95 put is saying Apple can fall to $70 and I don't lose that much money. I stopped losing money at 95. Those are your three options. Like I said, the short call is the most intense, is the least intense in terms of how much defense you're playing. That collar is really, if things crash, that's really, really going to stop the bleeding, and you can only lose a defined amount. And it's the same. I'm not going to go through all of them, but from the short side, I know there's fewer of you out there, people who are just short a bunch of stocks. But if you are short futures or you are short stocks, playing that side of it, you can do essentially the same thing: sell a put or buy back 50% of that position, or do, I don't even know if there's a term for this, like an inverse collar, which would in essence be selling a put and buying a call, defending against a big rip higher. And is that a good place for defining these strategies, Michael? How do you feel about these varying intensity and strategies?
I love this, actually. I'm a huge proponent of covered calls. I think they're an understated strategy that should be used by more people. I do have a question, though, and this is just so beautiful. You're really giving some high quality content here in the lion suit, and I respect the hell out of it. It's fantastic. But with your collar, so if you're long stock, we know about option skew between put and call prices. Sure. Do you try to finance the purchase of that put with the short call?
So I'm glad that you asked a question that gets a little bit more nitty gritty here for a second with that collar, because it's not so simple. You go to the options page and you've got a ton of options for the call that you need to sell and the put that you need to buy for this long position. What I personally do is I will probably just like, because there is put skew, the put is going to be more expensive than the call that you're selling. I will try to just get that trade to net out at zero.
Okay.
So I'll sell, like if I need to sell the 103 call to buy the 95 put for zero, that's what I'll probably do there. And so what you're in essence doing is you're selling a call for the same amount that the put that you're buying is. And you can vary that along that scale, right? Like if you want to only lose $5 or you're willing to risk more, you'll lose $10. You adjust the call accordingly there. That's how I would do it. But that said, you can do whatever you want there. And just to finish up here, Michael, you know what else traders can do? They can take advantage of this increased volatility. A great part of defending this volatile election that's coming out, putting that short call on your Apple or putting that collar on or just taking 50% of it off the table. Greatest part of going to the dentist, Michael, being able to eat candy, right? Like you put these defensive strategies on. And so on election night or the day after, you can come to the small exchange futures. And now, since you had less risk going into the event and the market is shaken up and you think, oh, that's too cheap or that's too expensive, I can now feel good about speculating further and taking advantage of what we will see, which is increased volatility.